What a great question. So the question is T by E, tenancy by the entireties, available to same-sex couples? It depends on the state. So, and this issue has not yet reached the U.S. Supreme Court. It will, eventually. For tax purposes, married couples include same-sex couples. That has been decided. That was decided about 3-4 years ago by the Supreme Court. But for non-tax purposes, depending on the state, the benefits of being a married couple may or may not go to same-sex couples. So in Virginia, that's still an open question. In Maryland, it's clearly applicable to same-sex couples. In D.C., clearly applicable to same-sex couples. Virginia, still an open issue. Although I think it's going to fall by the wayside with our current Attorney General. He's very much in favor of extending all benefits to same-sex couples, including all property ownership benefits. Question?
So brokerage accounts and bank accounts can be in Virginia now TBE. Are you finding financial institutions are allowing that to happen? This got brought up to me by one of my clients who said their estate attorney recommended it, and I said, well, my bank doesn't allow that except in Florida.
Okay, here's your answer, and let me repeat the question for the benefit of the listeners. The question is T by E, tenancy by the entireties, available to all do all financial institutions make that designation available? The answer is no. That's only because the financial institutions haven't caught up with the law. And number one. And number two, unfortunately, a lot of the people in your compliance section need to be educated. And so I spend a lot of my time on the phone with them, educating them. And it can be designated in an other designation on the account. And I've done it at your bank.
Can you call them? Can you call them?
Can I call them? I have, multiple times, in different advisor situations. But yes, by law, they have to make that available because it's a legal designation by statute. And then the harder question is, husbands and wives can own financial accounts T by E, but then can they separate that account and put it 50-50 as T by E in the name of two trusts? Again, the statute expressly provides for it. The statute is Virginia Code section, write this down, 55-20.1, capital B. Because I have to talk about it every single day. And it is a legitimate designation that we just need to teach the banks. They need to get their compliance up to speed. It's basically the case.
One trust becomes irrevocable because a spouse passed away.
If the account is held in two trusts as T by E, then it goes to the other trust. If it's held as tenancy in common, 50-50, then 50% is irrevocable in that trust, 50% is in the revocable trust.
And you lose that TBE, it automatically becomes TBE.
But once a trust becomes irrevocable, you have real asset protection at that point. Revocable trusts generally do not have asset protection, except in this limited case that I was describing. But an irrevocable trust does have asset protection, subject to the terms of the trust. So it's not black and white. You have to look at the trust terms to figure out what kind of asset protection you really do enjoy. So the legacy is the last thing before we get into IRAs and retirement plans. And again, how do you want to be remembered? To your heirs, to your family, to charity, etc. Do you want to include charities in your giving plan? More and more wealthy individuals are doing this. You know, it started, didn't start, but it was really made public with Buffett and Gates. You know, basically have designated all but $50 million of their estate to go to their respective foundations, and Buffett's foundation is going to pour into the Gates Foundation. In fact, he's already given significant amounts over to the Gates Foundation to manage, because they're an operating foundation. They do a lot of good stuff around the world. And so he decided that it was good to just basically turn assets over to the Gates Foundation and let them manage it for the benefit of the charitable classes that they serve. But more importantly, what values do you want to pass on? It could be religious values. It could be economic values, whatever it is that whatever it is that you want to pass on, you can actually articulate that and design your documents around that, particularly the revocable trust. What I did recently for a client, the client has 3 sons, 2 of whom are suffering from mental illness. And so what we did was we built guidelines in the trust that apply to all 3, but they wrote a letter to the trustee outside of the trust to express their wishes and specified how each child should be treated and what their issues are. It's really helpful to do that. And I helped them draft it. They drafted it mostly themselves, but I helped edit it so that it didn't create any problems with the estate plan. Okay? So it's a good idea. You can attach it to the trust. You can have it as an appendage to the trust or as an addendum, however you want to do it, but it's really important to do it. IRAs and retirement plans. So the big question is, you have to designate a beneficiary of an IRA or a retirement plan. If you don't do it, what happens? It goes through probate, and you have made a big mistake as the financial advisor, and I've made a big mistake as the estate planning lawyer not to at least advise the client to do it. If they don't do it, shame on them. But every IRA and retirement plan must have a beneficiary designated. Now, here comes the next question. It's sort of a trick question. Who do we usually designate as the primary beneficiary of an IRA or a retirement plan? Spouse. Uniformly, everybody says that. The problem with that is, and it is a problem sometimes, but I still do it in more than 50% of all estate plans. The problem is that if you name a spouse as the beneficiary of the IRA or the retirement plan, you may create unintended beneficiaries, like the pool boy or a charity who would be designated in lieu of your children. One of you in here, and I won't look at you or talk about you or the client that we have, but we had a concern about a client that the spouse would give everything away to charity and basically cut off the kids. That's not good planning. That's not what the primary earner who generated the retirement plan wanted to do. Or a nursing home romance. I've actually seen this happen several times, where there's an older person in a nursing home or at home who's taken advantage of by a caregiver, and they convince them to change beneficiaries on the IRA. So while it's the norm and it allows the surviving spouse to roll over the IRA into their own IRA, stretch it out over their lifetime and get benefits along those lines, there's a risk associated with it. I have a solution for you. We'll talk about it in a second. Do you have a question?
No.
Just stretch it. All right. Unmarried owners of IRAs. We have a lot of those. Divorcees, widows, widowers, people who never got married. We have a lot of those folks. And they may designate their children or family members as the primary beneficiary. If you've got young children, then they have the ability basically to pull the assets out and use them immediately. Even at the age of 18, I got into this big argument with one of my clients the other day about a UTMA account that he had set up for his kids. And we have a lot of clients like this. They kept funding, UTMA accounts with $14,000 a year, and then all of a sudden, at the age of 18, there's $350,000, $600,000 in this account, whatever, a lot of money in the account. And the client says, I don't want them to have it. What's the law? You don't have a choice. It's an irrevocable gift. It belongs to that child. Well, I'm not telling them about it. Well, you're a fiduciary and you can be sanctioned under state law. It's a crime. In Virginia, it's a misdemeanor for you not to turn those assets over. I don't care. I'm not going to do it. So we have solutions for that too, which we'll talk about in a later session. More advanced planning solutions. But the idea is that we don't want kids to get the assets before they should get them. It's really up to us as financial advisors, estate planners, to tell our clients what might be an alternative than just naming the children. And so, again, it doesn't have any asset protection. It can be gotten by their creditors. It could be subject to immediate tax if they pull it out and use it. And, you know, they may want it right away, especially the 18-year-olds, especially my 18-year-olds, all the way up to 25-year-olds. I've got, you know, 4 kids, and they're all almost 18 or over the age of 18. If I gave them the money that's in my IRA, they'd take it out in a heartbeat and spend it. So what do you do? Well, again, protect yourself and your family, pass the assets when you want, to whom you want, create a legacy. So one of the solutions that, it's not just me, there's lots of advisors out there who are using this, and there's multiple benefits to it, is to create an IRA, inheritance or legacy trust. A separate trust. It can be a revocable trust. Again, is it employed to sell additional estate planning services? Yes. Is it used, and is it something that would be beneficial to our clients? Absolutely. Why do we do this? We want to segregate this IRA. I have clients who have, you know, I have one client who's got $7 or $8 million in their IRA or 401k accounts, and that's a lot of money to have in an IRA. First of all, if the asset is in an IRA, it's asset protected from bankruptcy up to a maximum amount. Did you know that? It's not unlimited protection. The federal law provides a maximum cap, which is adjusted every 3 years by COLA adjustments. And that amount is about $1,345,000 right now. That's it.
And it's
It's not per account.
I was going to say it's not cumulative across accounts either. It's just
It is cumulative across accounts. It is limited to a cumulative amount. So if you have 10 IRAs that total $7 million and one's only $1 million, all the IRAs are limited to $1,345,000. So it is a cumulative limitation, not a per account.